Okay, welcome back to Chapter 9. We are on page 3, and we had just finished calculating the present value of a bond we purchased and recording it. So now we're going to set up an effective interest amortization table for the 8% bonds purchased to yield 10. So the yield is going to be 10. Okay. So, cash received. Do we receive each 6 months 4% or 5% of the face? Well, if we look at our actual payment, what it says on our little piece of paper, we only get 4%. Here's the 4%. Here. 0.8 times 6/12. So we're going to put 8 divided by 2 is 4% here for the cash. And the interest we get is the 10 divided by 2, so that's the 5%. So always start there. Now, this is a bond discountization. We call it discount because did we pay the full $1,000? No. We paid a discount less than 100,000. The opposite of that is a premium. More than face. So let's do our little chart, and this is the effective interest method. IFRS requires it, ASPE allows it, but it also allows straight line. Okay, I'll talk about straight line after that. I was going to tell you to remind me, but you're not. Okay. Let's use black. So, on the very first day we buy them, nothing happens, and we put the price in here, $922.78. Now, what's going to happen is this number has to get to 100,000 at the end. By end of life, or the 5 years. Okay? So this is going to keep increasing till finally it gets to be 100,000. Okay? As a premium, it would be bigger and it would get smaller. So a premium be bigger and get smaller to face. Okay, here's the critical thing. How much cash are we going to get every 6 months? Now, we've already calculated it, but you take the 100,000 times the stated rate times 6/12. So 100,000 times the stated rate times 6/12. So we get 4,000. Is it going to change? No, the interest is always going to stay the same. Now, the interest income we're going to calculate is at 5% of the amortized cost. So we're going to take 5% times the balance up here, 92278. Which equals 4614. Now, the bond discount amortization is the difference between the two. So we just take 4614 minus 4,000 equals 14. So, remember this has to change and become face value. So am I going to take this little amortization part and add it or subtract it? Well, I have to add it to get this to keep increasing to 100,000. So that's going to be 92278 plus 614. And I'll just put a little note. Would be subtracted premium. So this is added because it's a discount. This has to get bigger. Premium, you do the same kind of thing. You'd subtract it so it gets smaller. So that equals 92892. Okay. So pause it, fill in the second row, and then we'll see how you did when you come back. So you take 5% times 92892, 4645. This is 4645 minus 4000 is 645. Again, we want this, and notice we take it from this number. So we need to add 645 is 93537. And this also would get subtracted. Or premium. So that's the hard work. Now you notice we didn't get to 100,000. That's because we need 4 more payments. So if you want on Excel, you guys, try it out. Sometimes you have to adjust that, the interest income, if it doesn't work out. We won't worry about that too much. Once you get to 316, you're going to do the whole amortization table for a bond, so you'll be doing that there. Okay. Record the entries for the first 2 interest payments and the entry at maturity after the final interest payment has been recorded. So we already did the January 1st entry here. Let's do the July 1st entry here. So remember, we bought the bond. So what are we getting? Cash, 4,000. Now, this bond, what does it represent to us? It's not a liability. That's Chan's liability. What is it to us? That's an investment. Remember, we debited investment in bonds. So this 614 is either going to be debited or credited to investment in bonds. So actually, let's write investment in bonds up here to remind you. So, are we going to add it or subtract it to a bond? Well, we're going to add it. And our bonds are our investment because we bought it. Is that an asset? Yes. So how do we increase an asset? We debit it. So we debit investment in bonds for 614. And this represents interest to us. So we're going to credit interest income. 1,4. Do you kind of see how that table works? So I'm just going to put a thing. We're increasing our bond investment, just to remind you. So if it was a premium, this would have been a credit. Okay, so now January 1st, 2018. Well, pause it, you guys. Try and do the entry for this, and then come back. Okay, so we're going to debit cash. We still only get 4,000. This is our investment in bond for 645. We need to make it go up. So we're going to debit investment in bond for 645. And then we're going to credit interest income for 645. Now, the last thing, the The entry at maturity after the final payment. I'm just going to put it here so it'll fit. So the interest payment has been recorded, okay, the last time. This balance would be 100,000. We get cash, 100,000, and we credit investment in bonds for what it says here, 100,000. Now, I'm just going to about this, okay? I'm not going to worry too much about doing it, but if we sold it, let's say we sold it right here, and we sold it 25,000, you'd fill in all of this and how much you got, and then you'd have a gain or a loss, okay? We're not going to worry about that too much on the investment side of the bonds. Where you will do it is in 316 when you have bonds that you issued and they're redeemed early. Okay? So right now, really what I'm concerned about is that you can do this. Okay. So that's the amortized cost method that we use for long-term debt that we've bought of other companies or other entities. So on page 4 then, we're going to talk about now the fair value through net income model. And this applies to long-term passive investments in debt or equities which are not being recorded at amortized cost for IFRS. Okay, so it's mostly equity though, but it can also be those. Fair value through net income would be used for all equity investments quoted in the active market for ASPE. So we've talked about these already, little by little. So under this model, investments are measured at fair value at acquisition. Any transaction cost being expensed. So let's say you had a broker fee, credit for whatever it is. That's broker fee. My writing is getting worse. Now, here's the key thing. At each reporting date, the asset is measured at fair value, so it's an adjusting entry, with any unrealized gains and losses reported in net income. Now, along with any transaction costs, any earned interest, if it's debt, if it's shares, and any unrealized gain or loss in the investment should be reported together as investment income or loss in net income. They can also be reported in separate accounts, so you will see differing practices. Under ASPE, interest and dividends must be reported in separate accounts, so separate them. When sold, use net income accounts for gains and losses. So don't put OCI. So take a sec, read through the example. I'm going to switch to video and then we will continue.